why consumers and businesses will likely see higher interest rates. It has to do with a strong economy. With economic growth spurred, inflation has started to climb. So the Fed has signaled that it might be time for interest rates to rise, which is a strong, because they kept saying like pump the brakes. We're not going to increase the interest rates. Things are going to stay strong. I believe, if I recall correctly, through 2024, and then they would see, reassess. Interest rates may be going up. The Federal Reserve believes that the economy is in good enough shape that it is time to start weaning it off of the massive stimulus it has been pumping into the system. Is that good news? The answer, of course, is yes. Is the economy really in good shape? According to this article, yes, it is. Growth is strong. During the spring and summer, the percentage increase was the second largest on record. Even better, the level of activity now exceeds where it was in when the pandemic hit. In addition, the nation's unemployment rate has plummeted, dropping nearly 10 percentage points since April 2020 pandemic peak. Job gains are robust, and there are more job openings than the number of people unemployed. In other words, the economy is back, and that is the key, because the Fed has a dual mandate: maximum sustainable employment and stable prices. The maximum sustainable employment portion seems to be in sight, but stable prices, I'm not so sure. Strong growth coupled with high inflation point out the tensions in the Fed's mandate. Sometimes a rapidly expanding economy can trigger price increases. When you add a global supply chain meltdown to the robust economic activity, you have real consumer price problems. Inflation is running well above the Fed's target of the 2% average. So what does a good central bank do when the economy no longer needs its assistance and inflation starts showing its ugly head? You raise rates. And that is the path in which the Fed has embarked. When the pandemic hit, the economy crashed. The Fed used every tool at its disposal. It lowered the rate it controls, the federal funds rate, to near zero, and all the other rates followed. The Fed also opened the liquidity spigot, buying massive amounts of securities, and it also added more than $4 trillion to its balance sheet. And ultimately, the economy. One reason the stock market has surged is the enormous influx of funds wound up not just in the economy, but in the financial markets as well. With the recovery well established, it was time to rethink policy. At the September meeting of the Federal Open Market Committee, the Fed's rate-setting group, it was announced that if the progress continues broadly as expected, the committee judges that the moderation is the pace of the asset purchases may soon be warranted. In other words, the Fed is starting to get out of the economic support business. What does this mean for the average person? It means if it starts with interest rates and spreads to the general economy. The purpose of buying securities was to lower the interest rates across the spectrum of assets, from very short-term, such as 3-month treasury bills, to long-term, such as 30% fixed-rate mortgages. The Fed did a fantastic job, and the rates are still at or near historic lows. By reducing its asset purchases and most likely selling them some later, the Fed will be ending the downward pressure on rates. So this continues on and on. But basically, I'm excited to see that they think that the economy is starting to wake up in a big way. Now, the real test will be, when we actually get to Christmas. Because my concern is that companies aren't going to be able to make their targets. Not because people aren't there to spend, but because they do not have the inventory to be able to have people buy. So what I would be looking for, other than to start going Christmas shopping now and not waiting till December, or even Black Friday for that matter, is I would be looking for opportunities for you to uh, take advantage of before the rates start to go up, right? Like if you had some, if there's any opportunities you have to like, if you needed that loan, it might be the time to get it before the rates start to go up and then things start to increase. If you were, if you needed to buy that vehicle for your company, if you needed to get that piece of equipment and you can still, cash in and get that low interest loan, it might be time to take that. It's still a bit of a risk because I see, if we get out of this without another variant, that will be incredible. But even without another variant, I think we're still 6 months to a year before things are really back to like this is all of 2020 and 2021 are in the completely in the rearview mirror, assuming that there isn't another variant that pops up that is either more dangerous or spreads faster or anything to that effect. So as long as that's the case, I think in six months to a year we could be out of the woods, so to speak. And the thing is it does, when they change the interest rates and stuff, it does not have the effect of instantaneous. It doesn't all happen overnight, right? It takes time. They change the rates. The effect has to, is felt over time. So we're gonna have to wait and see how this starts to shake out as we get closer to the holiday season.